Welcome to our panel discussion on the August 2025 edition of Mindfields, Momentum Investments research publication dedicated to engineering certainty in an uncertain world. I am Eugene Botha, head of the Research Hive at Momentum Investments. Joining me today is Joshua Gisa, quantitative research analyst, Evan Gilbert, research strategist, and Bongani Masungweni, quantitative research analyst. The purpose of Mindfields is to show our clients the depth of research we at Momentum Investments is focused on, as well as the importance of research in an evolving investments world. In this particular publication, we focus to turning investment complexity into clarity, not only for our clients, but also for our portfolio managers. At its core, investment management is about improving the odds of success amid uncertainty, not just chasing returns, but delivering outcomes that matter to clients when they need them and within the risks they can tolerate. This edition brings together 4 perspectives that form a multidimensional toolkit for investment professionals. Reframing risk as the probability of achieving defined objectives rather than volatility. Making downside risk visible and actionable through a value at risk dashboard. Monitoring manager style exposures dynamically with returns-based style analysis, and distinguishing genuine skill from randomness using the MyPods framework. These tools replace ad hoc processes with disciplined, repeatable workflows that improve transparency, accelerate analysis, and increase confidence in every decision. Let's start with Evan. Evan, so why is it important to think about risk as the chance of meeting goals instead of just market ups and downs?
Look, I think it's very important for us to understand that we approach portfolio construction through an outcomes-based or OBI lens. This focuses on maximizing the probability of achieving specific financial goals rather than simply outperforming benchmarks. In terms of OBI, success is measured by the likelihood of reaching the predefined objectives, such as retirement income or capital preservation, with quantifiable probabilities, rather than relative performance, such as beating benchmarks or outperforming peers. After all, that's really what our investors care about. Can they actually do what they plan to do?
I get you. So how does this approach actually change the way we design portfolios compared to the old maximizing returns mindset?
Sure. Firstly, it means that we use probability as a decision-making tool. Every investment action has a range of possible consequences that can be quantified. Investors evaluate questions like, what is the probability this investment will enable me to reach my goal? This then also brings into focus the full distribution of potential outcomes, not just the expected returns. Secondly, it affects how we manage risk. In an OBI world, downside risk, capital loss, or failure to reach the goals matters far more than volatility. Traditional volatility measures treat gains and losses equally, which isn't suitable for this goal-based investing approach. Success is probabilistic there. For example, a retirement plan might have a 78% chance of success, but that means 22% risk of not achieving on the outcomes. So we review all of our proposed investment decisions through this lens. Does it improve these probabilities? Finally, it guides us also to look at different risk measures and techniques. We use risk measures such as value at risk that Josh is going to talk about just now, which gives you a sense of the negative outcomes of a portfolio might deliver, again, with a certain level of probability. Or even conditional value at risk, which is the average loss you might expect to experience, again, for that level of probability. We also use Monte Carlo simulation techniques to see how this range of outcomes might have played out, not just what happened historically.
All right, a couple of technical concepts which we'll unpack a bit later. But from your experience, what is the biggest benefit of using probabilities when making investment decisions?
It really highlights some interesting sort of trade-offs around portfolio decisions. I mean, for example, time horizon effects really matter when you're looking at designing and managing portfolios. Longer investment horizons generally increase the probability of achieving these inflation-adjusted objectives. For example, a balanced portfolio has a 71.2% probability of achieving a CPI plus 2% over 2 years, but about a 77% chance of delivering CPI plus 4% over 6 years. So, the outcomes really matter depending on the time frame that you're looking at. Generally, expected real returns increase with longer horizons, and Second, and moreover, the risk metrics give us a very good idea of what might happen below the desired outcome. For example, probability-weighted shortfall measures. It measures the expected underperformance relative to objectives when goals are met. For example, if a CPI portfolio fails to meet its CPI plus 2% objective over 2 years, it's likely to underperform by 3%, delivering minus CPI or CPI minus 1%. So these kind of insights, again, is something that you only get from an OBI kind of a lens, and traditional investing ignores that. Okay, finally, the risk profiles are more complicated than you might think. There are some trade-offs which are not always obvious to the investor. Different risk profiles, conservative, moderate, balanced, significantly influence both the probability of success and the size of potential shortfall. Conservative portfolios must struggle with ambitious inflation and targets, showing low probabilities and potentially higher shortfalls. So they might seem to be safer in isolation, but in that context don't work well. Riskier portfolios might be appropriate for achieving these higher return objectives, but this must be balanced against acceptable risk levels, particularly in the shorter term. So to wrap it up, for us, modern investors seek fund-specific life goals such as retirement, education, lifestyle, rather than abstract performance targets. We strongly believe that good investment decisions require this probabilistic awareness rather than deterministic thinking. Investment success for us is achieved through understanding and planning for uncertainty, not avoiding it.
Cool. So maybe turning to Josh, help us understand the concept of value at risk that Evan actually alluded to.
Yeah, absolutely. I mean, value at risk, or VAR, is a way of putting a number to the question every investor asks, which is, how bad can things really get? It tells us the worst loss that we'd expect to experience over a given period at a certain confidence level. For example, a 95% one-year value at risk of 8% means that only in 1 in every 20 years do we expect to see an outcome worse than an 8% loss. Unlike volatility, which treats upside and downside as the same, value at risk focuses purely on the downside. It draws a clear threshold of potential loss that makes risk tangible and relatable for both portfolio managers and clients.
All right, so risk numbers can actually feel very technical. So, how does a dashboard that you've helped develop actually make this easy for managers to use on a day-to-day basis?
That question is exactly why we built the VAR dashboard. So before, teams relied on complex spreadsheets and inconsistent methods that were slow and error-prone. The dashboard centralizes everything and also updates daily with real-time live data. So managers can see at a glance whether their fund is still within its drawdown limits, what's driving risks in terms of their asset allocations, and how proposed trades would change that risk. It's interactive too. A manager can adjust an asset allocation and instantly see how the portfolio's drawdown profile responds. Instead of risk being an after-the-fact check, it becomes part of everyday decision-making.
All right, so in your article, you also reference a client experience VAR. So what is that and why does it matter?
So when investigating value at risk and how it's calculated, I saw something that was a very undesirable trait for our clients, which is that value at risk is very strict. So traditional VAR tells you about the risk from the portfolio's perspective, but clients experience risk emotionally. It's not, on fixed 12-month windows or whatever the time horizon we set as. So imagine an investor who deposits 800,000 Rand in a momentum fund. 3 months later, their account balance peaks at 1 million Rand, a gain of 200,000 Rand that sets a powerful anchor in a client's mind. In their mind, now they've hit 1 million Rand in their portfolio. Over the next 9 months, markets retreat and the account closes at 750,000 Rand. That feels to them like a 25% loss, even though the official 1-year return is only negative 6%. Client experience VAR attempts to bridge this gap by combining 3, 6, and 12-month value at risks to reflect how investors perceive market movements over time. It's a much more human behavior-aware measure of drawdown that helps advisors and portfolios have more meaningful conversations with clients.
All right. Okay, so maybe Josh, moving on to the next article around returns-based style analysis. What's really the intent of the returns-based style analysis tool?
So the RBSA tool aims to see what styles of factors a manager is actually holding and it allows us to reconcile that against what they say they're holding. By analyzing a fund's return history, the tool estimates how much of the performance behaves like the various styles, which we believe have associated risk premia, such as quality, momentum, and value. In other words, it turns raw returns into clear factor fingerprints. Because it's built on Momentum Investment's own factor definitions, RBSA speaks in the same language that we use in portfolio construction. It's objective, data light, and fast enough to be used routinely.
So effectively, your tool shows what styles managers are really using. So, how often do you actually feel that managers drift away from what you expect?
This actually happens quite often, and that's why the tool has become so valuable. Managers naturally adjust their style exposures as markets shift or teams change. But those shifts can create unintended concentration risks at the total portfolio level. RBSA highlights that drift in near real time. Instead of waiting for annual reviews, we can see when a value manager starts behaving more like a momentum manager, and we can kind of start that conversation early. It keeps our style diversification intentional rather than accidental.
Right, so there's lots of tools to our disposal. But even with these tools, we stand, and when do we need human judgment?
Well, tools like RBSA don't replace human judgment, they strengthen it. The model shows how a manager returns behave, but not why. It's still up to the analyst or the portfolio manager to interpret whether a style's shift is strategic, opportunistic, or unintentional. Like any model, RBSA has limits. Overlapping definitions and window choices can blur results. But when combined with good judgment and qualitative insight, it gives a much clearer and more timely view of manager behavior.
All right. Okay, so Vangani, maybe shifting to you and your particular article. It's about pods. So, but what is pods, and how has the concept actually evolved from pods into my pods?
Thank you. This is actually a very funny thing that came about. When we started looking at pods and what it means, pods in its essence is short for portfolio opportunity distribution sets. It is a framework that evaluates investment skill by comparing actual portfolio outcomes to a distribution of possible outcomes that could have been achieved under the same constraints but without the manager's skill. Essentially, it measures performance relative to the opportunity set available to the manager. MyPod builds on this concept by tailoring it to momentum investments, research process, and local data environment. It incorporates our factor definitions, realistic portfolio constraints, and transaction cost assumptions. This evolution makes the framework more practical and interpretable for our multi-manager platform, providing a skill assessment that reflects how manager operates within our investment universe. Now that pods. Now the funny thing is, when we look at it, it's our own definition of pods and how we see it and how it can improve how managers value the fund manager's skill. Now, Evan looked at it and was like, this is my pod. This is a momentum investment pod. So this is our perspective, and this is how we assess our managers.
I don't think that's funny. I think that's clever. But
My pods. It's my pods.
exactly. Yeah, Eugene, just to build on that, Vangani and I collaborated on this, and what essentially my pods, the version of pods, it does is it compares managers to, there's a joke in investment management about monkeys throwing darts at a dartboard and seeing what that return is, And sometimes clients say, well, a monkey could have done a better job. And the reality is that you operate in a constraint, and sometimes monkeys will do better. And that's really what the pods distribution gives you, is a sense of what could randomly, in other words, completely randomly, throwing darts at a dartboard, what might have happened, and then where did the manager fit inside that distribution. So it's a very simple approach, but actually quite difficult to implement, and that's why we had to do the My Pods to make it work for us in our context, our factors, our constraints, and the transaction cost to make it realistic.
Perfect. Adapted to our needs and
Exactly,
in the way that we feel we can get the most value out of it.
Yeah.
So, your method actually compares managers to thousands of random portfolios. So, how does that help us know if a manager is really truly skillful?
By comparing a manager's realized returns to a distribution of thousands of no-skill portfolios under the same rules, and whether it's the opportunity set that we're looking at, and where we can see whether managers' performance sits in that distribution. If their returns consistently fall in the upper tail of that distribution, say above the 90th percentile, it suggests that the manager's results are unlikely due to be by chance. So that monkey throwing dots analogy that Evan used. Now, this part's approach isolates skill from luck. Since every simulated portfolio faces the same constraints and the same market conditions as the real manager.
Okay, so we applied within the space of equities. So, can this be applied to other asset classes or in other areas as well?
Yes, absolutely. So when we were looking at the study, we had the same conversations. We did the study on equities, and then we looked, can this be applied elsewhere? And the POD's framework, and by the extension of my pod, it is asset class agnostic. So the main principle of it can be applied anywhere. It does not look at that specific asset class, but can be extended to other asset classes as well. As long as we can define the investable universe that we're looking at, the return series, as well as the realistic constraints that are the same logic will always apply. We plan to extend the framework to fixed income next, where the challenge will be defining comparable no-skill portfolios that respect duration, credit quality limits over the same similar extensions could also be spotted.
Thank you to our panelists for sharing these insights and to our audience for watching. The key takeaway for me is clear. So while markets remain uncertain, disciplined frameworks and evidence-based tools are essential because they turn complex data and uncertainty into clear, actionable insights. They help investors make informed, consistent decisions by quantifying risk, improving transparency, and aligning portfolios with real-world goals rather than relying on guesswork. We look forward to seeing these innovations in action.